Hello to everyone, and welcome to this new episode of 5 Minutes. Today, we will talk about US presidential elections, what implications for emerging markets, with our guest Marcelo Carvalho, former managing director and global head of economics at BNP Paribas. Marcelo, welcome to 5 Minutes. It's a great pleasure to have you here. Marcelo, after the recent presidential elections, we will relatively soon have a new American administration. So what does the outcome of this US election mean for US fiscal, trade, and immigration policies?
Luca, thank you very much for the invitation. It's a pleasure to be here. And you're right. Those are the three topics I think we should focus on when thinking about implications for emerging markets. First, on fiscal policy, Trump has promised to renew tax breaks and actually maybe even intensify those without corresponding cuts on the spending side. What that means is that in the short term, these are expansionary policies. Those add demand fuel to an economy that has been quite hot. That's in the short term. In the longer term, you have a problem of debt sustainability. It's increasing borrowing needs, which will mean that the yields are going to increase in the long end of the curve in the US. So first point here, fiscal policy is more expansionary in the near term, adds concerns about the debt dynamics longer term. Second point, on tariffs, if Trump delivers what he has promised, there would be 10% tariff on all imports. There will be 60% import tariff on everything that comes from China. This is clearly inflationary. I mean, products in the US imported from abroad will be more expensive than otherwise. And the third point here is regarding immigration. Likewise, Trump has promised to have a crackdown on migration, tighten the rules, maybe deportation, massive ones. Once again, this tends to be inflationary because economists will describe it as a negative supply shock, meaning it doesn't help growth at all on the supply side. At the same time, that makes prices higher. I mean, think about workers in agriculture, the hospitality sector, and construction. If you don't have those workers anymore, it means that prices go up.
Thank you. So how will the US Federal Reserve likely respond to it?
Well, it complicates the life of the Fed because you see, Luca, the Fed has been cutting interest rates from a peak of 5.5% earlier this year, has cut already twice this year. It's a bit below 5% now. And the plan originally was to continue to cut rates because inflation seems to be not too far from the 2% target. The economy is doing okay. So otherwise, the Fed will be cutting rates through the course of next year. However, as I mentioned before, if those policies introduced by Trump, meaning intervention on immigration, on trade, on fiscal side, if those are all inflationary, it seems very likely, then the Fed will not be able to cut the way it thought before. So maybe they don't cut as much. Maybe they'll have to cut more slowly. And we can think about extreme scenarios where maybe the Fed even stop cutting at all and may consider hike interest rates if inflation is starting to deviate from the target, and particularly if inflation expectations start to prove unanchored.
And so what does this mean for emerging markets?
Look, it's not good news for emerging markets for three main reasons. First, on the trade side, emerging markets that export to the US will now be facing higher import tariffs by the US. This is not good news. Second, if the Fed is leaving with rates higher than otherwise, this actually discourages capital flows towards emerging markets. And in fact, as a result, you have a stronger dollar than otherwise would be the case. Well, if the dollar is stronger against the rest of the world, including emerging market currencies, are weaker. And weaker currencies for emerging markets feed into inflation in emerging markets and therefore complicate the life of central banks in EM, in emerging markets, that otherwise would be hoping to cut interest rates. And then last but not least, You have the trade concern, you have the dollar capital flow concern, and also have the security concern, because be it in the Ukraine, be in the Middle East, it doesn't look a Trump administration would bring a fast resolution that would be helpful for emerging markets. To the contrary, it looks like uncertainty is here to stay, and looks like we're probably living in a more dangerous world than otherwise would be the case. So in sum, unfortunately, it doesn't look like a Trump administration will be particularly good news for emerging markets.
So essentially, sorry if I go back to the emerging markets, but your final comments. So overall, this is not going to be good, right, for the emerging markets? It's going to be good or bad? Very bad?
I think it's bad overall. Of course, there are winners and losers within emerging markets. So if you are particularly exposed to trade in the US, like Mexico is next door, it can be bad news. If you are, however, in Southeast Asia and the US diverts its imports from China towards those other countries like Vietnam and so on, there may be potential winners as well. So there are potentially winners and losers within emerging markets, but for the group as a whole, I think the outlook is not particularly encouraging.
Thank you so much, Marcelo, for this really inspiring discussion. And we wish you all the best, and we really hope to see you here again at 5 minutes. Thank you very much.
Thank you. Bye-bye.